All right, so I want to just take a couple of minutes and create a video here that would help you guys get through the last part um, of the financial assignments. I don't have or haven't completed an actual written assignment sheet. Simply because it will just tell you to create the pro forma income statements and the pro forma balance sheets using the examples out of the book. So now that I've said that narrative, it's going to be more valuable for you to watch this video and then participate in the Q&A when we can have that. And once we get to that point, I will get you guys lined out so you can finish up this business plan. So let me just start off here with the pro forma income statements. And my preference has been to kind of work everything by the years. You'll notice that I've actually reorganized my tabs. And so I've gone from my starting balance sheet, I've gone to my operating budget for 2020, my cash flow 2020, my pro forma income state for 2020, balance sheet, and then I now go over to my budget for 2021. If you've never moved a tab in Excel, all you do is you just hover over the tab, click on the left mouse key, hold it down, and while you're holding it down, you can move it in between the next tabs, and you can see how that moved for me. I'm just going to go ahead and do that again. Click on there. I'm going to go to the left. You can kind of see how the little black arrow hovering right above my little cursor will tell me exactly where that's going to be. So anyway, that was the first thing I did. I like to reorganize it. Just it kind of helps me out. So let me go back to the the income statement. So income statement's pretty simple. Most of this stuff, if you actually look here, I'm bringing this in from my operating budget. So if you remember on the operating budget, come up here to the top, we basically projected what our revenue would be. I had a totals column here, which basically is just a sum of everything for the year. Same thing with my direct costs. And of course, going back to our formulas, gross profit is equal to our revenue minus our direct profit. Okay, so, and then we've got all the general administrative overhead stuff here. So in the income statement, I basically just brought over the revenue. I brought over the direct costs. I did the math. I actually verified that my 49,200 worked out to be the same over here. So I had that little checkpoint right there. And then I brought over my general administrative operating expenses, which again came from the operating budget. My totals clear down at the bottom right here. And then you can actually see right here that I took my gross profit, subtracted my G&A expenses to come up with what my net profit before taxes were. So you can see that that's actually really all the income statement is. So if you look at this right here, what you can basically see is that for my first year, I had an operating loss of about $61,000. Now, I'm not overly concerned about that because I had a lot of expenses in getting up and running before I could even get into my first contract. And that's not uncommon. Businesses often have to take out a little bit of debt to get rolling. And then as long as you're being profitable, then you're going to wipe out that debt and hopefully start making some profits for each year. So let me come to the pro forma balance sheet then. So the one thing I want to have you guys look at here, and I've already got an error, and that error for mine is that should be not June 30th. That should be December 31st of 2020. So the reason that came up like that is I originally just copied over my starting balance sheet to keep the formatting there, and then I just neglected to change that. So I do want to have my first pro forma balance sheet as a snapshot, and that's the one thing, if I haven't said that already, the pro forma income statements and the pro forma balance sheets, they are a snapshot. So the way I look at this on my balance sheet simply is at 5 o'clock on December 31st, 2020, this is what my balance sheet looks like. Same thing with my income statement. On December 31st at 5 p.m., this is what my income statement looks like. So it's just a snapshot, okay? So on my balance sheet, you can see that what I've done here is I have added some assets here. So what I've done right here is I've created construction contracts. So construction contracts, if you have a signed contract, that is actually considered an asset for you. On the other side of the equation, under my current liabilities, you'll also see that it's also a liability, meaning that, hey, I've got a contract that's worth $216,000, but I have to perform that work still, so it's a liability. So on the balance sheet, it actually essentially balances out, it kind of wipes it out, but that's what it was. The way I came to this contract amount was this. I actually created another page. I called it contracts. And what I did is I took my 8 projects that I had created, and I basically said, okay, I've got a couple of errors here. Let me correct that. That was incomplete. So basically, for my contracts for 2020, I had a $1.2 million contract. And in that $1.2 million contract, what I determined, and I got to go back to my assumptions here, is in project number 1 in that first year, I completed, I'm going to come back over here. So in my first year, here we go. This is the work that I completed. So basically, I'm going to do a quick sum function right here. So basically, I completed, of that contract I had, $984,000, which should leave me a total of $216,000 still to create. So because I've completed the work in place, I've completed that part of the contract and whatnot, that's no longer an asset. Because I've already completed it. Now a portion of it may be an asset because it depends whether or not I've been paid for the work or not. So first off, that's how I came up with what my asset of what the balance to complete contracts are. Now, on my accounts receivable, basically, I made this as real as possible. So if you remember, in a true billing cycle, I'm in the bill at the end of the month for the work I've completed before. And what that means is once I've billed for it, that now becomes an account receivable. Okay. And so basically what I've come up with here is that I've billed for $162,000. That's part of this construction contract. It's not part of the 216, it's part of that 984,000, but it's what I have not been paid yet. I've billed for it, but I haven't been paid for it. And then finally, as far as an asset goes, I broke this out separately because basically in each of my projects, 10% retainage is being withheld. So that is money that is owed to me. However, I haven't been paid for it. So again, I'm counting that as an asset. So by putting in here the construction contracts, that's what I have in terms of signed contracts that I have not yet completed, the accounts receivables, and the retainage, I'm showing current assets of $476,400. Now you'll notice I have zero cash. That's just simply, I'm trying to keep this as simple as possible. In my cash flow, I basically spent all my cash on bills, and I'm operating completely on my operating line of credit. Okay, I didn't put anything different here as far as my fixed assets are concerned. Now, I want to keep this very simple for our class. Um, Technically, when you have things like office furnishings, computers, vehicles, and stuff like that, there is a depreciation that needs to be accounted for, but we're going to ignore depreciation in this business plan for now. Just keep it very simple. So we've got $37,500 or $37,500 in fixed assets plus our current assets. Our total assets now are $513,900. Now, let me look at the liabilities. So I talked about already our construction contracts are a liability. And you'll notice my accounts payable, that's the opposite of my accounts receivables. And what you'll notice is I've got 162,000 that are receivables, but my payables are only 120,503. In other words, the difference between that is, and the way I calculated this is all of this 162,000, that's what I've billed the owner. And of that 162,000 is dollars that I have to turn around and pay my subcontractors. So they're basically the subcontracts amounts that I need to pay from that. The close to what 42,000, just under $42,000. It's the difference there. That is actually money that comes back into my company to cover things like overhead and profit. Some of those things on the cash flow, I've already paid the bills in the operating line of credit. So essentially that 42,000, assuming that I've paid borrowed money on my operating budget, that 42 should actually be coming back in to help me pay some of that line of credit back down. Same thing on the retainage right here. Uh, the owner owes me just over $98,000 in retainage. However, of that 98,000, 73,000 is retainage that I'm withholding from subcontractors. And so there is a net difference there of roughly about $25,000, which means I've got about $25,000 and I'm financing of retainage of the 98,000, and the subcontractors are actually financing the rest of that. And then the other liability you'll notice here, and this came from my cash flow. In other words, I have to show that I owe money under a liability. So that number came from my 2020 cash flow. I put it in there as an absolute value, but you can see right here, $92,438 is what my operating, that's how much money I've borrowed. So my liabilities right here is 502,000 and some change. And when I come down here and, before I go any further, I did use that loan amortization table tab that I created, and I figured out basically how much based on my loan that I paid. So in the year 2020, I paid off $892 principal of my company vehicle. And so my debt is now only $9,100. My dump trailer, I paid off about $625 of the debt. Same thing with my enclosed trailer. So I basically showed that as the as what the current debt as of December 31st of 2020. Okay, so take the long-term debt and the current liabilities. I got $518,000. And if you remember from our accounting equation, assets is equal to our liabilities plus our owner's equity. You'll notice at this point, my owner's equity is negative $4,109. Okay, I started out with $50,000 as an investment. So if you actually add that back in there, I'm at a negative net worth right now. Okay, so if you have a negative owner's equity, it just basically means that you owe more money than what the company's worth. Okay, not too concerning on the first year out. Now let me move forward here to year number 2. So first off, I'm going to come here to my cash flow. Well, let me start with my operating budget. I went back, and as I started looking at everything, I did come back and make some new assumptions. I decided I was actually over-resourced when it came to my personnel for the number of jobs that I had. Um, I had too many people and paying too many salaries, and it was too much of a drain on my company. And so I actually reworked my overhead. Um, so anyway, everything up here was pretty much the same. So you can see my revenues, my direct costs, my overhead. And you can see right now, if I come to my pro forma income statement, I've just brought that same information over. So at the end of year number 2, what you'll notice is that my net profit is still at a negative, but we're doing just fine. If we actually go to the pro forma balance sheet, now this gets a little bit maybe more confusing, because on the pro forma balance sheet, I did the income statement just based off accrual accounting. And so, and when I looked at the balance sheet, I actually took into account the offset of me billing and actually getting the revenue coming in. And so, anyway, that being said, again, let me just go through this. Zero cash, construction contracts, basically with what I have in terms of what signed contracts left to complete, $360,000. I have $270,000 on whatever my contracts out there. This is what I've billed and have not been paid. This is how much retainage is out there that basically is being withheld from me, which belongs to me. Therefore, it's an asset. Again, I haven't done anything with my fixed assets, my total fixed assets, my current assets. So I'm up at 831,500. And then same thing, my construction contracts are also a liability. There's my accounts payable. Once again, my receivables are about 69,000 more. But most of that money will go back into my company to pay down my operating loans. That's the retainage I have that's due and payable to other parties. Again, you'll notice that there's about, what, 40, just around $40,000, just under $40,000, what, 38, that is actually belongs to me. And then the rest has to be paid out to my subcontractors. And then again, going back to my cash flow, where I ended up at that year is I figured that I have about $17,000 is what I owe. Again, this is the last day of the month, December 31st at 5 o'clock. So current liabilities, I once again reduced I may have an error there. It doesn't look like I've actually reduced the company vehicle. I may have missed that one. But you can see that I've reduced the dump trailer as far as what I've paid that off. Actually, I know what's happened here. I'm going to fix this really quickly. So this is what I paid off in the next year, but what I didn't do is actually bring in the previous years. And that previous year's was 892. Perfect. That is what that should look like. Okay, so when that's all said and done, what it's actually looking like right here is that my owner's equity has actually gone quite a bit up. So instead of being a negative $4,000, what it actually looks like is I've made some money this year. I've have my initial investment of $50,000, plus it looks like about another $64,000 is what I've increased the value of my company in that year. Okay, in my final year here, let me just go through the same things here once again. So I've come through all this, and from my operating budget, I figured out what my revenues, direct cost, figured out my gross profit. And in this year, you'll notice that I actually have income tax. So I got a profit of about $44,000. Of that $44,000, it's going to be taxable. I just figured about 28%. And then my net profit after tax is about 32,000. So the only thing that's going to change now when I come to my last year's balance sheet is, again, here's what I have in terms of contracts left to complete. That's what I have in terms of accounts receivables. That's how much retainage I have out there. So you can see I've got quite a bit going. My company's growing. I've got more contracts. So things are looking pretty good there. Again, I haven't really made any changes to the fixed assets in this case. I didn't really see any reason to do that at this point. Okay, what other items? So under liabilities, construction contracts, accounts payable, this is all just figuring the same thing that I was showing you before. But the one item I did add in this year, because it was the first year I was actually showing a profit, is that I have a liability, which is my taxes payable. So I've got to put that in there. What that'll do is actually reduce my owner's equity by the $12,560. And as we come in here, you can see my owner's equity at this point is now $73,527, which actually is pretty good at this point, considering. So that is essentially what you have to do to complete the last part of the statements here. And again, if things start looking a little bit out of whack, you need to start trying to figure stuff out. You should see a trend as far as your profitability. If you have debt, that debt should be going down. You'll notice in my cash flow this last year, I had almost $336,000 out on my operating line of credit. Again, on the asset side of the equation, under my accounts receivable, that's where that money will be coming back, hopefully, to pay some of that operating line of credit down, as well as my accounts payable. You get the idea there. So anyway, that's just a really quick demonstration for you guys. I'm going to post this on YouTube, and hopefully you get a chance to watch it and work some things out. And next time during class time, we'll go ahead and have kind of a question and answer.